morning, everybody, and welcome to the Fred Report conference call for January 27th, 2011. Nice new year. We've had some wonderful weather we've been talking about here. Atlanta is nice and warm in the 50s, but I was just with my girlfriend in New York talking to her, and it's very cold and snowy. So everyone that's in warm climates should be happy, I guess, if that's what you like. In any event, let's get started on the markets here. We're doing pretty much what we thought we would do, which is we are rallying, we are flirting assiduously with the 130 area on the SPY. In fact, we just got up there today and went slamming through there to 130.16 and are now below it. I'm still looking at this being an up week, and after that, we do have a little bit of a danger signal on the weekly Fred's price oscillator. What that means is we could finally start ourselves a little bit of a correction, and it could be fairly sharp looking. How would I react to this? I guess the first thing is this is not a sell everything signal like we said. If I am stopped out of stuff, I would hold the cash for now and look to redeploy it. The reason I say that is I think the biggest trade by far for 2011 is going to be a buy signal after some correction here. I want to point out to everybody again, I know I've been writing about this, but there are all sorts of signs that foreign money is going to start coming into this market. The S&P is really outperforming both emerging and developed markets, ETFs, and indexes now. And there's a real sign, and just anecdotal evidence talking to people that work in developing markets funds and things, that there's a real desire to take those profits and find another place for that money. And if that's the case, we should see a year of very strong outperformance in U.S. names, and I think that would be a surprise to most people right now. So I guess our market position here is the spiders could correct to 118 to 120. I'd be surprised if they went below there. That's going to be a buying opportunity, and we could see a move into the 140s from that area. Now, we may not get the correction. We may just go up, and if that's the case, that's fine. We're more than willing to accept that. Basically bullish here, but looking for some sort of a pullback. Let's talk about the bonds here for a minute. We're getting some questions on those. Our accumulation models are showing buy still on the bonds. For traders, a rally should start in these bonds no later than next week. Otherwise, I would say it is probably a bad short-term buy signal, but the models are suggesting that we still want to be accumulating bonds, and what that means is even if rates go a little higher than here, they will be lower than here later in the year, and that'll be an opportunity to sell bonds for a capital gain. I do want to point out one thing here, and I guess we'll look at, first of all, before I do that, we're going to go to commodities, and let's just talk about oil real quick. Oil is coming down in line with the seasonal tendency to peak late January and come down. We've seen the USO move from roughly 39.20 to 36.55. This is all normal, but I'm watching this situation in Egypt, and I don't think people are giving a lot of credence to the fact that the longest-running peace treaty with Israel happens to be Egypt versus and Israel. And if Israel ends up with a bunch of nuts on their borders, or I shouldn't say nuts, I should say radical Islamists or something of that nature, we could see oil stage another move up that would be contra-seasonal. I'm certainly more than willing to hold energy stocks. I would just make sure that my stop losses on the XLE are in. I would be using 67.50. Or so as a stop loss there in case some of these come off. But I do think oil is going to be a better sector next year, and the reason for that is I think as economic fundamentals get better later in the year, in the second half of the year is when we're looking for this, you're going to see real demand for these commodities, not just inverse movement with the dollar. And if we see that, oil and oil stocks are going to do very well. We had a bunch of questions on gold the other day. We're going to talk about gold here for a minute. It looks like the GLD is trying to hold that 127.50 to 131, 133 support area. we're expecting gold to be kind of flat here for the next few months. We note that silver prices really sort of forecast that gold was going to weaken. It became an outperformer. That's what usually happens. I am looking at the SLV, and I'm seeing the possibility of correction in the SLV down to 24. We got close to 25.50, the first support, down to 24 by May in a sort of a choppy movement. If that happens, gold could get to 126 to 129 on the GLD. Gold stocks come down a little bit more. The last consolidation and the previous to that consolidation in gold basically lasted for 5 months, and that would put us into May. And then I'm expecting gold to have a very, very good year going into the end of the year. When I look at some of the agricultural stuff like JJG and MU, those are suggesting there's already food demand out there. Those are areas I want to be in, especially on pullbacks. I would be watching them. I'd keep positions in them. If I didn't have any positions in them, I'd buy positions in them, but realize that we could get a sharp drop into the spring and then a very strong summer rally in those along with oil. That pretty much covers most of the markets. What we're going to do now is take a quick look at some of our stocks that we have questions on.